Hello students, hope you all are well. Let us start our next video on the basis of elements of accounts part 2 of standard 12. Students, last video I completed the part 1. This video I will start the part 2. It is not unknown to you that you are having total 13 chapters. Out of that, first 7 chapters that is included in part 1 and remaining 6 chapters are included in part 2. In part 2, all these 6 chapters, I put the number for this chapter's name not 1, 2, 3, 4, 5, 6. Instead of that, 8, 9, 10, 11, 12 and 13. Chapter 8 will be the accounting for share capital. Chapter 9, the accounting for debenture. Chapter 10, the company's final account. Chapter 11, analysis of financial statement. And chapter 12, accounting ratio and analysis. And the last one, that is chapter 13, cash flow statement. According to the board paper style, you are having total 100 marks paper. Out of that, from part 1, you will have total 52 marks, and part 2, you will have 48 marks. That means from first 7 chapters you will have 52 marks, and remaining 6 chapters you will have 48 marks. Today I will start you the first chapter of part 2, that is chapter 8, accounting for share capital. In this chapter, according to the board paper style, total weightage is 10 marks. It is given, it is here 10 marks. This 10 marks, one MCQ of section A of 1 marks, one question from section B, that is also 1 mark, and one long practical sums from section E. Section E means 3 long questions are there, 8 marks each. Out of these 3, 1 long questions, practical sums, will come from this chapter. So 8 plus 1, 9 plus 1, 10. Section E, you are having total 3 practical sums, that is 1 from chapter 5 of part 1, 1 from chapter 6 of part 1, and 1 from chapter 8 of part 2. So let you know what is called the accounting for share capital. Before starting this chapter, first of all, some of the theoretical part you have to know, because this theoretical part will help you to do the practical sums. If you do not have certain knowledge from the theoretical part, when you will start doing the practical sums, you will feel difficult. For that, you have to know the theoretical part, as well as you are having the question from theoretical part also, because one question from section A as well as one question from section B also is going to come. So you should know the theoretical part also. The first video of chapter 8, the accounting for share capital, I will give the introductions as well as the theoretical part. Then slowly you will go to the practical sides. This chapter is totally based on the journal entries. The practical sums of 8 marks, what you have to know, that is journal entries. Journal entries of different situations. What type of journal entries you are going to do? Now this chapter will tell you how company is collecting money from the shareholder by issuing the share. This is the main things which you are going to learn from this chapter. How company is collecting money from the shareholder by issuing the share. This is the main which you have to know from this chapter. But before that, you have to know what is called company. The definitions of the company already you have learned from the 11th standard, and also the place or the mark where I have marked it. These are the point I am explaining. You also will follow. These are the things at that. Indian Companies Partnership Act, it was passed in the year of 1932. which I completed from the last 7 chapters. That was all this part 1 7 chapter. It was under the Partnership Act 1932. Now onwards, the first chapter of chapter 8, that is Companies Act. In India, the first time a separate act for the company was passed in the year of 1956. 1956 is the Companies Act, 1932 is the Partnership Act. MCQ questions may come. So in India, first time a separate act for company was made in 1956. It's known as Companies Act 1956. Recently, the Indian government has incorporated New Companies Act 2013 after necessary amendment in the previous act. From 1956, first Company Act was passed. In this act, the definitions of the company, rules and regulations, memorandum, articles of association, everything it was mentioned. And from 56 to 2012, there was no change was this Companies Act. But now in the year of 2013, there is a certain amendment act was passed, and the Companies Act in 2013 after necessary amendment in previous act. And what change was given, that was implemented from 1/4 of 2014 onwards. The chapter deals how a company raise capital, what I told you. This chapter will tell you, the chapter deals how a company raise the capital. It discussed the several points in this reference and their accounting effect in the company's books as per the Companies Act 2013. Now you have to know the how many types of companies are there. That may come in the section A as well as the section B. Also will help you to do the practical sums. Several times I told you. The companies can be classified in different ways. First, it is classified on the based on the establishment. Based on the establishment, the companies are mainly two types. One is the statutory company or corporations. Another is the registered company. Most of the companies are coming under the registered company. Most of the companies are coming under the registered company. But what is the statutory company? The registered companies, what are the act was there, rules and regulations are there. The statutory company, there is something change is there. Like that life insurance corporations of India, New India Assurance Company Limited, Gujarat State Finance Corporations, Gujarat State Civil Supplies Corporations, etc. These are the companies also coming under the Companies Act 1956 or 2013. But these are the companies are established by a special act. It is not that act what is applicable for the registered company. There is something change. Statutory company or the corporations, these companies or the corporations are created by a special act. There is a certain change of state or the central legislations. For example, LIC, for example, New India Assurance Company Limited, Gujarat State Finance Corporations, Gujarat State Civil Supplies Corporations. These are called the statutory company. Means their act, their rules and registered company rules is slight change. The registered company, the company which are registered or formed under the Companies Act are called the registered company. Most of the company are, it is coming under the registered company, what I told you. Next it is coming on the basis of that, as per the Indian Companies Act 2013, that there are the two main types of companies are there. One is the private company and another is the public company. Now you have to know what is called the private company and what is called the public company. The private company means the private company is one which by its articles of association restrict their right to transfer of the share, limit the number of the member up to 200, the profits invitation of the public for subscribe for any securities or shares or debenture of the company, most of at least 2 members. That means private company, to become the private company, there is some restrictions is there. These are the restrictions which company is following. There numbers of members minimum 2, maximum 200. But in case of a public company, the minimum 7, maximum unlimited. Like that, there is a restrictions for the right to transfer of the shares. In case of a private company, there is a restrictions, they cannot transfer the shares to the, and next is there, they cannot invite, invitations they cannot give to the public for to subscribe their shares, and their minimum number is 2. These are company coming under the private company. And if it is a private company, there, this is also most important, the name of the private company ends with the word private limited. Wherever the name is given, there at the last the word private limited, this should be mentioned. From there, public can understand this is a private company. ABC private limited, like that. You see, it is that the private limited. So private limited word should be mentioned in case of a private company. And public company definitions is not given. Only it is given which is not private company, that is public company. A company which is not a private company, a company which is not a private company is called the public company. A public company must have at least 7 members, and at most there is no limitations, unlimited, and there is no restrictions on the maximum numbers of members. Name of the public company ends with the word limited. So here the last word of the name of the last word would be limited. There name of the last word will be private limited. See, this is called limited, Infosys Technologies Limited, like that. Next it is coming the based on the liability of the member. Again, the company are classified on the basis of the liability. What liability? The liability means 3 types of liabilities are there. One, company limited by the shares. Another one, company limited by the guarantee. Another one, company by unlimited liability. Already you have learned from the 11th standard OC, this type of questions are there. Again I want to repeat it. Company limited by the shares means how many shares you are going to buy, that many shares multiply the face value. Face value means price of the shares, whatever the amount is coming, that much amount is your liability. If company is going to wind up, or company is going to close, or company is getting huge loss, your liability is that how many shares you have purchased multiplied by price of the each share is called company limited by share. That means आप जितना share purchase किया multiply by, suppose if you are buying 100 shares and each share cost is ₹10, that means 1000 is your liability. Company limited by the guarantee मतलब suppose sometime it may happen that you are giving guarantee that I have purchased 1000 shares but I have given the guarantee 2000. So maximum guarantee whatever you are giving, that is your limited, that is your liability. So company limited by the guarantee means how much amount you are giving guarantee, that is your liability. And next is coming company limited by unlimited. Unlimited means there is no restrictions of liability. How much amount is required to pay back the money to the outsider, that much money, if it is not enough in this company, then you have to bear this money from your home. That is no restrictions or no limitations. Company limited by unlimited liability. Unlimited liability, there is no limitations of the liability. Next point is coming, that most important points which is based on that particular what is called journal entries which you are going to know from this chapter. That is third point, share and share capital, the meaning, nature and type. Share and share capital, what is the difference between the share and the share capital? Capital means every one of you know, the money which is invested by the owner, money which is invested by the most of the case money or any assets which is invested by the owner towards the business is called capital. But what is called the share capital? Share capital means in case of a company, huge amount is required to start the business. this much huge amount it is not possible to invest by 1 or 2 or 3 or 4 persons. The company got the permission from the government that this money they want to collect from the general public, those who are interested to buy the share. What is called the share? That how much money they require, this much money they are converted into the number of shares, and each share who will buy, that they will be considered as a shareholder. So when company is issuing the share to the public and public is buying the share, company gathering the money by issuing the share is called share capital. Only capital the few owners are giving, and share capital when numbers of shareholders are there, they are paying this money, is called share capital. Here it is given, the capital of the company is called share capital. Capital of the company is called share capital. Capital of the particular sole proprietorship is called capital. The capital of the company is called share capital, which can be divided into transferable small denominations. Each such unit of denominations is called share. How much money it is required, that is divided into number of share, each share it is called the particular share. To raise the capital, company issue the prospectus. Prospectus means one type of book where everything, rules, regulations, details about the company will be mentioned, is called the prospectus. To raise the capital, company issue the prospectus as required by law and invite the public to purchase its shares. Those who purchase the share of the company are called the member or the shareholder of the company. If you are buying the share of this company, you will be considered as a member or you will be considered as a shareholder of the company. Is not it? And company will give the prospectus to you. Prospectus means one type of book for giving for advertisement, to know about the company, because whenever you are going to buy the shares, you should know about the company. How you will know about the company? If you get the prospectus in details, in this prospectus everything should be mentioned, and on the basis of that you will take the decision whether you will buy the share or not. Now, how many types of shares are there which company can issue to collect the money or to gather the capital from the public or from the shareholder or from the members? That is, already you know there are two types of shares are there. One is called the preference shares, another is called the equity shares. Preference shares and equity shares are the two types of shares company can issue to collect the money. Now, what is called the preference shares? Already you have learned from the 11th standard, even though I want to repeat once again what is called the preference share. That shareholder who are getting benefit first preference they are getting to get the dividend or to get the interest, that type of shares are called the preference shares. Matlab, means is there, company is having suppose two type of shares, equity shares as well as the preference shares. First, preference shares will get the preference to get back their interest, that is called preference share. Preference shares is one which gives the preferential right to its shareholder for receiving the dividend at a specified rate before any डिविडेंड पेड टू द इक्विटी शेयरहोल्डर. इक्विटी शेयरहोल्डर का पेमेंट करने का पहले जो शेयरहोल्डर को फर्स्ट देना है दैट इज कॉल्ड द प्रेफरेंस शेयर्स. मतलब फर्स्ट प्रेफरेंस शेयर्स विल get, then excess money whatever it is there, then equity shareholder will get, but preference shareholder will get a fixed rate of interest. Now, types of preference shares, the question may come from that MCQ as well as the section B. How many types of preference shares are there? According to your book, there are the 1, 2, 3 and 4 type of preference shares are given, but actually it is not the 4 type of preference shares. Actually you are to having the total 8 type of preference shares. Each type having two. See, convertible, cumulative and non-cumulative, redeemable and irredeemable, participating and non-participating, convertible and non-convertible. So it is not the 4th type of preference share, it is 8 type of preference shares are there. Let me explain one by one all these 8 type of preference shares in short. First is coming the cumulative preference shares, and non-cumulative preference shares. What is called the cumulative and what is called the non-cumulative preference shares? Sometimes it happen that you have purchased the preference shares, but this year's company did not get the maximum profit or company got the loss, and whatever rate of interest the company has to pay to you, this year company could not pay. Now this year due, if it is paid in the next any year where company will get the maximum profit, that type of preference share if you are buying, that is called cumulative preference share. Cumulative preference shares means if any year company is getting loss or not getting enough profit, particular that year, if company is not able to pay the rate of interest on preference share, that money which year company will get maximum profit, that year company can pay the previous year due. That type of preference share are called the cumulative preference share. In case of a cumulative preference share, if any year the dividend or on the preference share is not paid due to insufficient profit, such area of the dividends shall be paid together with the current year dividend in the year when there is a sufficient profit. You understand? And non-cumulative means that will not be, this facility will not be there. Matlab, if any year loss is coming, that year preference shareholder will not get the interest. Redeemable or irredeemable preference shares. Redeemables means redeem. Redeem means repaid. Generally preference shares after a certain numbers of years it will be redeemed. It will be redeemed means suppose you have purchased the preference shares and after it is for the, whenever you are buying, that time everything it will be mentioned. Suppose it is for 5 years. After 5 years that company will give back the original money, how much you have purchased the shares, preference share, and these 5 years you will get the certain fixed rate of interest. Now redeemable or irredeemable, there are two type of things is there. Redeemables means that your original price, principal's amount you can get back after a certain numbers of years. That will be mentioned. It may be 5 or 6 or 7 or 8 or 9 or 10, whatever it is. So suppose if it is given that after 7 years the shares will be redeemed. So first 7 years that money company will keep, and this 7 years you will get the interest, and after 7 years you will get their principal money. That is called redeemable preference share. Redeemable means that number of years, certain numbers of years it will be not mentioned. When company will close, a preference share which are redeemed only at the time of liquidations. Liquidation means when company is going to close, that time you will get back your principal money, and that many numbers of years you will get interest. That is called redeemable and irredeemable. Participating preference shares and non-participating preference shares. Again there are the two type of shares are there. One is the participating preference share and another is the non-participating preference share. What is given? The preference share holder who hold the participating preference share get fixed rate of dividend as per the decided by the company. Participating preference shares, in addition to that, they also have a right to participate in the surplus profit. Generally preference shareholder they will get the fixed rate of interest every year. But there is another type of preference shares are there which is called the participating preference shares. If you are buying the participating preference shares, after getting the fixed rate of interest, if company is having some extra surplus profit after paying to all, from that surplus profit after paying to all they can claim certain money. That type of shares are called the participating preference shares. Do you understand? Once again I am telling, suppose company is having huge profit. First, according to the conditions, the participating preference shares, suppose 8% they are paying. After paying to 8%, then they will pay to the others, and after that equity shareholders. After paying to the equity shareholders, even though if they are having any excess or the surplus profit, then this participating preference share can claim. That is called participating preference shares. Non-participating means only the fixed rate, whatever it is mentioned, only that they will get. From that surplus they cannot claim. Last is coming convertible and non-convertible. Convertible means can change it from one place to another place. Convertible means sometimes the company give the chance or the offer or the benefit to the preference shareholder that you can convert to the equity shareholder. So if you are buying this convertible preference share, then only if company is giving a chance you can convert to the preference shareholder to the equity shareholder. मतलब from preference share to equity share में convert कर सकता है. But if it is a non-convertible preference share, then you cannot change. You will be the preference shareholder only. You cannot be the equity shareholder. Next is coming the equity shareholder. Equity shares or the ordinary share. Equity shares का another name होता है ordinary share. There is no definitions of the equity shareholder, only it is given which is not preference share, that is called equity share. The share which are not preference share, that like the private company and public company. The company which is not the private, that is public. Similarly, here also the share which are not preference share are known as the equity share. Equity shareholder have the voting right of the company. Generally, equity shareholder the main owner of the company. They are having the voting right of the company's meeting. Dividend on equity share which is decided by the board of director, it is not a fixed. If maximum profit comes, maximum benefit you will be dividend you will get. If less profit comes, less dividend you will get. And approved by the shareholder in the general meeting is given only out of the profit remaining after the distributions of the dividend on the preference shares at a fixed rate. Preference shareholder को पेमेंट करने के बाद जितना बचा रहेगा सब इक्विटी shareholders will get it. Next is coming the types of share capital. Types of share capital in the next video practically I will tell you in details. Only this video just I want to tell you. Share capital that you already came to know, the money which you are getting from the shareholder or collecting from the shareholder is called the share capital. There are so many classifications of the share capitals are there. Authorized, nominal, registered capital, issued capital, subscribed capital, called up capital, uncalled up capital, paid up capital, reserved capital. These are the practical sides. Slowly I will explain in the next video. Next, it is coming for the share. The share, now company after getting the permission from the central government, the company will give the advertisement in the paper and they will start collecting the money. That is their step for issue of the equity shares. Company raise its capital by issuing the equity share to the public or by private placement. Either they can issue to the public or they can give to the private placement. For issue of the share for the public को issue करने के लिए permissions for the issue, details of the proposal by the sent by SEBI, others to the public, details shows in the prospectus, and for share application, share allotment and other installment. The page number 6 and the page number 7 just you will go through. Already I told you that system. Why once again I want to tell you, if company wants to collect the money from the public, the company has to get the permission from the government. After getting the permission from the government, company will issue the prospectus. By seeing the prospectus, public will take decision whether they will buy the share or not. If they want to buy, they will send the application to the company. This is the system for issuing the share to the public. But sometimes it may happen that company can issue the share by private placement. Instead of issue to the public, they can issue to the private placement also. Private placement also means that they can issue to their relative, to their friends, to their boundaries. That is called the private placement. And there is a one MCQ most of the years. This I want to read you, just you follow. As per the Companies Act 2013, a company may issue the share on private placement basis also. Sometimes the promoters of the public company are confident of raising capital through private sources and contact. In such a case, the company does not invite the public to subscribe for these shares. Matlab they cannot invite to the public, but to make the private placement of the share to the promoters, their friend, their relative, the mutual fund, shareholder groups, and other companies like that they can issue. Here, one MCQ may comes. So many times I have seen that one. That what is called lock-in period. That lock-in period you should know. In case of a private placement, not the public. So there are the two places are there. One company can collect the money from the public place, another one private place. In case of a private placement of the share, the LOT will not sell. LOT matlab those share is accepted. The LOT will not sell their share for a certain minimum period. Certain minimum period, how many? That is not mentioned. That is given in case of a private placement, not in public. In case of a private placement of the share, the LOT will not sell their share for a certain minimum period from the date of allotment. जो डेट पे allotment हुआ वो डेट से minimum certain number of period they have to wait to sell. This period is called lock-in period. Lock मतलब लॉक कर दिया, ये लॉक का अंदर आपने वो सेल नहीं कर पाता है. That is called lock-in period. Now, next is coming that sometime it may happen that some of the MCQ or section B they may ask from the inside. That in MCQ that they may say what is the full form of SEBI, ACBI. SEBI का full form it is given here. The SEBI is full form Security and Exchange Board of India. Page number 6. You will find out the Security and Exchange Board of India is called ACBI or SEBI. SEBI will take decisions after investigations all these things whether you will be given permissions to collect the money from the public or not. There is the rules is there that whatever the numbers of shares you want to issue, that the two type of subscriptions may come. One is called the over subscriptions and is called the under subscriptions. Over subscriptions means numbers of applications you may get more than your issue share is called over subscriptions. Under subscription means numbers of shares how many you have issued you can get that less than applications. Matlab just example if I see, if you are issuing 1000 shares you may get application 1500, it's called over subscriptions. If you are issuing 1000 shares, if you are getting 700 shares, it's called the under subscriptions. If you are getting over subscriptions, the excess applications you have to refund or reject. But if you are getting under subscriptions, means how many shares you wanted to issue, less than that you got that applications, then there is a rules is there. That rules it is given that at least 90% money, 90% you have to collect, 90% of your issue shares. If you are not getting 90% within the 30 days, then you are not supposed to continue the business. It is given it here. If applications are received for less numbers of shares than the shares issued, how many shares you have issued, less number of shares if you are getting that applications, it is known as the under subscriptions. That according to the SEBI guidelines, company must get share applications money for at least 90% of the amount called up for the public subscriptions. Matlab if you are issuing 1000 shares, at least 900 shares should be accepted. The minimum amount of the subscriptions should be received within 30 days. That also time limit is given. These are the things it is required to know the MCQ as well as the section B also for the practicals. So maximum limit 30 days you have to collect the money from the date of the issue of the prospectus. If company fails to get the minimum subscription, then company cannot allow, then company cannot allot any share, and within 15 days the total amount should be returned to the applicant. If company fails to return this amount within 15 days, then interest at the rate of 15% per annum has to be paid for each day. So suppose if it is not possible to give back within 15 days, then with the interest 15% they have to, company has to pay. Next point is coming that company can issue the share either at par or at premium. At par or at premium, and also issue of the share at a discount. There are three types of there. These three types I will go in details when I will do the practicals. What is called the at par, what is called the at premium, what is called the discount. Even though in short I want to tell you, at par means the same face value. Suppose its face value is rupees 10. 10 shares, 10 rupees shares will be issued at 10 rupees, is called at par. Premium means that if face value is 10, you can take little more. Suppose 2 rupees extra you can take, 10 plus 2. This 2 rupees which extra you are taking, that is called share premium. And discount means if share price is 10 and you are giving suppose 2 rupees discount, that means you can collect 8 rupees. Discount means less than the face value, premium means more than the face value, and at par means same price as the face value. So now slowly I will start the practical sides. In next video I will tell you that practical sides. Okay, hope you are understanding. Okay, bye.